For many aspiring real estate investors, the traditional path of buying and managing physical properties presents significant barriers, high capital requirements, hands-on maintenance, and local market risks. Fortunately, modern investment vehicles like real estate crowdfunding platforms and real estate investment trusts, REITs, have democratized access to property investments, allowing individuals to participate in real estate markets without the headaches of direct ownership. These alternatives offer unique advantages, including lower entry costs, portfolio diversification, and passive income potential, making them attractive options for both new and seasoned investors. Understanding how these instruments work and their respective pros and cons can help you determine whether they align with your financial strategy. Real estate crowdfunding platforms have surged in popularity over the past decade, leveraging technology to pool capital from multiple investors for specific property deals. These platforms, such as Fundrise, CrowdStreet, and Realty Mogul, typically focus on commercial or residential projects, apartment complexes, office buildings, or even large-scale developments like hotels or shopping centers. Investors can contribute relatively small amounts, sometimes as little as $500, to fund these projects, earning returns through rental income, property appreciation, or profit sharing upon sale. Some platforms target accredited investors, high-net-worth individuals, with higher risk, higher reward opportunities like ground-up developments, while others cater to non-accredited investors with more conservative, income-generating properties. Unlike direct ownership, crowdfunding eliminates the need for property management, as sponsors handle everything from tenant relations to maintenance. However, these investments often come with limited liquidity, as funds are typically locked in for several years, and returns depend heavily on the sponsor's execution. REITs, on the other hand, provide a more liquid and diversified way to invest in real estate. These publicly traded or private companies own and operate income-producing properties across sectors like healthcare, retail, or logistics. By law, REITs must distribute at least 90% of taxable income to shareholders as dividends, making them appealing for passive income seekers. Publicly traded REITs, such as those listed on the NYSE or NASDAQ, can be bought and sold like stocks, offering daily liquidity and transparency. They also provide exposure to large-scale, institutional-grade properties that would otherwise be inaccessible to individual investors. Private REITs, while less liquid, often target higher yields and may focus on niche markets like self-storage or data centers. A key advantage of REITs is their built-in diversification. Instead of tying up capital in a single property, investors gain exposure to a portfolio of assets across geographies and sectors, reducing concentration risk. However, REITs are not immune to market volatility. Their values can fluctuate with interest rate changes, economic cycles, or sector-specific downturns, as seen during the pandemic's impact on office and retail REITs. Comparing crowdfunding and REITs reveals trade-offs between control, returns, and accessibility. Crowdfunding allows investors to cherry-pick specific projects or markets they believe in, potentially yielding higher returns if the project succeeds. For example, funding a luxury apartment development in a booming city could deliver outsized profits upon completion. Yet this approach requires due diligence on sponsors and projects, and failures can result in total losses, risks akin to venture capital. REITs, by contrast, offer professional management and diversification, but with less control over individual assets. Their returns, while generally more stable, may be muted compared to top-performing crowd-funded deals. Fees also differ. Crowdfunding platforms typically charge sponsors, not investors, but may take a cut of profits, while REITs incur management fees that can erode returns over time. Tax treatment further distinguishes these options. REIT dividends are often taxed as ordinary income rather than qualified dividends, potentially resulting in higher tax bills. Some REITs, however, allocate portions of dividends as return of capital or capital gains, which can defer taxes or qualify for lower rates. Crowdfunding returns may be taxed as ordinary income, capital gains, or even passive activity income, depending on the investment structure and holding period. Certain platforms offer opportunities to invest through self-directed IRAs, enabling tax-advantaged growth. For investors weighing these alternatives, consider your goals and risk tolerance. If you seek hands-off diversification and liquidity, REITs, especially ETFs holding multiple REITs, may be preferable. If you're comfortable with illiquidity and higher risk for potentially greater rewards, crowdfunding could complement your portfolio. Many investors blend both strategies, using REITs for stability and crowdfunding for targeted growth. Ultimately, real estate crowdfunding and REITs have transformed property investing into an accessible, scalable wealth-building tool. No landlord responsibilities required. By understanding their mechanics and aligning them with your financial plan, you can harness real estate's income and appreciation potential without ever mowing a lawn or fixing a leaky faucet. Whether you're starting with $500 or $50,000, these innovations let you claim a stake in the property market on your own terms.